Welcome to The Explainer. Today, we're going to pull back the curtain on a line item that most people just skip, but hiding inside are some incredible secrets about a company. I'm talking about deferred tax assets. And trust me, this is not just boring accounting. It's a powerful signal about a company's past, its hopes for the future, and, whether the profits you're looking at are even real. Let's get into it.
So here's our game plan. We're going to start with the fundamental puzzle that even creates this whole thing. Then we'll nail down what a deferred tax asset actually is. We'll see how accountants put them on the books, and most importantly, we'll learn how you can use them as a pretty sharp analytical tool. And we'll wrap it all up with some really fascinating stories from the real world.
All right, first up, the profit tax puzzle. We've got to start here, because this is the root cause of why deferred taxes even exist in the first place.
Okay, let's dive right in. Have you ever wondered why the profit a company reports to its investors is almost never the same number it reports to, say, the IRS? This isn't a mistake, and it's not necessarily some shady business. It's actually a built-in feature of our financial system, and understanding this difference is absolutely key. It all boils down to this. The two systems have completely different goals. Financial accounting, with its rules like GAAP or IFRS, is all about giving investors and other stakeholders a clear, transparent picture of a company's economic health. But tax accounting? Well, that's designed by the government for one main purpose, to collect revenue. Because they have different goals, they follow different rules. It's like they're speaking two different languages, and that creates a gap that accountants have to somehow bridge.
So, how do accountants bridge that gap? Well, that brings us right to our main event, the prepaid tax asset. This is the really clever accounting tool that's used to reconcile these two very different realities. So, what in the world is a deferred tax asset, or DTA for short? The simplest way to put it is this. It's an asset that gets created when a company pays more in taxes today than its own financial books say it actually owes. It's basically a future economic benefit, a prepaid tax credit that the company gets to use to lower its tax bill down the road. This right here is the best way to think about it. It really is prepaid tax. Let's say you overpay your phone bill this month by $50. You now have a $50 credit that will reduce next month's bill, right? A DTA works the exact same way. The company has basically given the government an interest-free loan, and now it holds a claim, a credit, that it can use against any taxes it might owe in the future.
Now, I know this table looks pretty technical, but the logic behind it is actually quite straightforward. A DTA is created because of something accountants call a temporary difference. This just means the value of an asset or liability on the company's books, that's the carrying amount, is different from its value according to the tax code. That's the tax base. So, for example, as the chart shows, if an asset's book value is less than its tax value, poof, a DTA is created. You don't have to memorize this table. The key thing to remember is that it's these specific mismatches that create that future tax benefit we've been talking about.
Okay, so that table was the theory. Now let's get practical and see how accountants actually build these DTAs in the real world. What kind of common, everyday business events actually cause these assets to pop up on the balance sheet? Here are three classic examples. First, warranty expenses. A company has to estimate its future repair costs the moment it sells a product, which lowers its profit for investors. But the tax man says, nope, you can only deduct that cost when you actually spend the cash on a repair. That timing gap, it creates a DTA. Second, and this is a big one, net operating losses. When a company loses money, it gets a super valuable tax credit it can use to offset future profits. That future saving is recorded today as a DTA. And third, unearned revenue. Just think about an airline. It pays tax on your ticket the moment you buy it. But for its own books, that money isn't counted as revenue until you actually take the flight. So once again, it has prepaid its taxes, and that generates a DTA.
Okay, let's switch gears. We now know how DTAs get made. But if you're an investor or an analyst, there's so much more than just an accounting entry. They are a signal. So let's look at how you can read these signals to understand what's really going on with a company's health.
And that leads us to the million-dollar question for any analyst. Is a big and growing deferred tax asset a red flag? The answer, like with so many things in finance, is it depends. Let's dig into why that is.
A large DTA can definitely be a warning sign. For one, it might signal poor earnings quality. The company could be showing you these really rosy profits while telling the tax authority a much less impressive story. It can also be a tool for something called cookie jar accounting. This is a bit of a trick where a company, during a bad year, creates a huge valuation allowance, basically an estimate that they won't be able to use their DTA. Then, a few years later, when they need a little profit boost, they just reverse that allowance and boom, instant profit. It's exactly why lenders are so skeptical. They often just ignore DTAs when they're calculating risk, and it's why a high DTA balance is linked to future credit downgrades.
And here we have what is probably the single most important point of this whole discussion. A deferred tax asset is worth absolutely nothing if the company doesn't actually make money in the future. I mean, that tax credit is useless if you have no profits to use it against. That's why management has to go on record and state that it's more likely than not a greater than 50% chance that they'll be profitable enough to actually use it. And that judgment call is one of the most critical and closely watched estimates in all of finance. All right, enough with the theory. Let's see how this stuff plays out in the real world, where we're talking about billions and billions of dollars on the line.
Let's go back to the 2008 financial crisis. Banks were booking these absolutely enormous losses from bad loans, which in turn created gigantic deferred tax assets on their balance sheets. But here's the brutal irony. The bank regulators, the people whose job it is to keep the system from collapsing, they saw these DTAs as low-quality, phantom capital. So they essentially subtracted them from the bank's real capital reserves, which pushed the banks even closer to failure, even as this supposed asset on their books just kept getting bigger and bigger.
Now, let's look at the flip side, where the hidden value is. Fast forward to the pandemic. Airlines were grounded, burning through cash. United Airlines needed a massive $5 billion loan just to survive. And what did they use for collateral? Not their fleet of airplanes. It was their Mileage Plus loyalty program. And a huge chunk of that program's value was all tied up in deferred revenue and the very complex tax accounting that goes with it.
So what was that program valued at? Get this, a staggering $20 billion. I mean, this was a perfect example of how an intangible asset, something that's literally born from accounting and tax rules, had very real, very tangible value that could pull a company back from the brink of disaster.
And finally, let's talk about a risk that comes from completely outside the company: politics. The value of a DTA is tied directly to the corporate tax rate. So what happens when politicians decide to change that rate? Well, back in 2017, when the U.S. slashed corporate taxes, it was great news for future profits, but it instantly vaporized a huge chunk of the value of existing DTAs. Companies like Citigroup had to take immediate multi-billion-dollar write-downs, which took a direct hit to their reported profits for the quarter.
So, after all of that, what's the big takeaway here? How does knowing all this make you a smarter investor, a smarter analyst? At the end of the day, this isn't about memorizing a bunch of accounting rules. It's really about unlocking a higher level of financial intelligence. Understanding DTAs lets you read the story that's being told between the lines of the financial statements and the tax returns. It's in that gap that you find the real clues about what management truly expects, the real quality of a company's profits, and the hidden risks that they might not be shouting from the rooftop.
So the next time you open up a company's annual report, don't just scroll past that deferred tax line. Stop for a second and ask yourself, what story is this number trying to tell me? Is it a story about a company that's recovering from past struggles, holding a valuable tax shield for the future? Or is it a warning sign of some aggressive accounting designed to make today's profits look a little too good to be true? By decoding this one single line, you really do gain a powerful new lens to see what's really going on inside any business.